Now, moving on, market liquidity is deteriorating and volatility is spiking. That's an issue that John and I were talking about earlier. It is fueling fears that we are going to see a return to the kinds of conditions we saw after Lehman Brothers collapsed. We partner right now with the Financial Times to bring you Lex on Bloomberg so you can get a sneak peek at the FT's flagship column. A day early, Vincent Boland joins me now live from London. We're both here in London. Unfortunately, Vincent not in the same spot. Let's talk about why markets are so volatile.
Well, I think if you look at the sort of macro scenario that surrounds the markets at the moment, right across the world, actually, not just in Europe, where there's clearly a very severe sovereign debt crisis, but also in the US and elsewhere in the world, where there's a lot of uncertainty over regulation, the future of regulation, the future of banks, how big will they be allowed to trade on their own account? Is naked short selling going to be banned forever in Germany? Issues like that, all of that is playing into investor concerns, and that's why markets are so volatile right now. There's a lot of uncertainty out there.
Vincent, we have seen, for example, Libor rates rising, an indication that banks are perhaps a little less willing to lend to each other. Are you seeing further signs out there that liquidity is drying up?
I think that the chief sign is Libor, but there's a lot of volatility in equity markets too, and volumes in all markets, new issue markets in particular, are falling. The corporate bond market, for example, is at a very low point right now. There's very little issuance going on, and so across really all asset classes, I think there are signs of distress. And another sign is that banks, there's quite a squeeze on dollar liquidity. There's much more demand for dollars than there is supply right now. So that's another sign.
Vincent, thanks so much. That's Vincent Boland at the FT's Lex desk here in London.